Hi everyone, and welcome to this brief overview video of the Lab US Retail Market Entry Strategy Study, where we helped a Latin American wholesale bank consider whether they should go ahead and enter the US retail banking market. Now, this is a preview video giving you a very detailed overview of the study we are going to release in a few weeks. That being said, the premium podcast for the study have already started being released. You can see the first podcast up, and we'll release the following podcast very shortly. And the podcast contain material that you will not find in the PowerPoint or in any of the written material we will release, like for example the live blog and even the videos and so on. The podcasts are meant to tie together the analysis and provide material that we could not put into the PowerPoints, like conversations with the clients, actual audio recordings of how the client responded to issues and so on. So that being said, let's go straight into this study. So this study is designed in such a way that irrespective of who is watching it, provided you put in the required effort, you should be able to walk into any strategy, operations, or implementation assignment, depending on the study you are watching, and be able to complete it to the highest possible standard. So that's how we design these studies when we put them together. It's about making sure that whether you're a consultant, whether you're an MBA student, and particularly if you're an executive, which is, the programs are designed for actual consultants and executives, you don't have to worry about going through these very mundane programs that studied in MBA programs and so on, which don't really prepare you for real consulting studies, because the tools, techniques, methodologies we use in real consulting studies are very different from that taught in MBA programs. This is designed like an actual McKinsey and BCG study and is based on a real client, so you can see what happens in a real engagement. So that being said, let's get straight into the study. Lab, the client, is a Latin American quasi-state bank, quasi being used because it is majority owned by the government but not entirely owned. So the client here is the Mexican government. And Lab is a very special kind of state bank whereby the government set it up so that if you're an entrepreneur and you don't have the money, assuming you're a low-income entrepreneur and you don't have the money to start your own business, Lab would provide that income on an wholesale basis. On an wholesale basis means they don't have a retail model. So if you're an entrepreneur, you cannot contact Lab directly. You have to contract one of the retail partners through whom Lab works. So Lab has a number of channels that it uses to access the market. Let's talk about a few of these channels. I'm going to briefly touch on the two small channels, and they're not something you have to worry about too much. The first one is equity grants. Lab, through a channel partner, will sometimes take an equity stake in a business. Very small part of their business. Not much you have to worry about here. Lab also provides some type of mentoring, financing, funds smaller businesses, offering loans to low-income entrepreneurs. Also a very small part of their business. The two big parts of the business we need to worry about is the development financial intermediaries, or distribution financial intermediaries, depending on the term you prefer using. And basically what these are businesses in the United States. So they are family-owned businesses, usually consisting of a single branch, just one location. They look like payday loan vendors if you've seen them. In fact, they look exactly like payday loan lenders. You walk in there, provided you've got the right documentation and so on, they will provide you a loan, short-term loan to medium-term loan, to fund your business. And they mostly fund low-income immigrants of Hispanic heritage in the southern United States, but they've branched out to funding all low-income immigrants and also low-income citizens in the United States. There are 18 DFIs, so there are 18 of these companies providing loans all the way from $150 to $15 million. Some of them even provide larger loans because you're funding micro, small, very small, medium, and large businesses. So the loan sizes extend across a range from $150 to $15 million. Of course, the bulk of the lending is in the lower side of the segment. While there are 18 DFIs and most of them have one branch only, there are a few, about 3 of them, that have up to 20 branches. And those that have up to 20 branches, they fund a wide range of loan sizes, all the way from $150 to $15 million. The DFIs that have just a single location are usually pushing through very small loan sizes. Now, DFIs have traditionally been very unprofitable, and they have collapsed in the sense that of these 18 DFIs, only about 3 of them have been around for the last 5 years and longer. The rest, a significant amount of churn. When one shuts down, another one sets up. It's not a very easy business to be in. But this is one of Lab's primary lending channels. Primary doesn't mean it's a very big part of the market. It's pretty small, but Lab believes it has room to grow. Now, the other part of the market is Mexican retail banks operating in Mexico. So what happens here is that because Lab does not have its own retail network but wants to fund low-income borrowers in Mexico, and remember, this is Lab's mandate. This is why Lab was created, to fund low-income borrowers in Mexico. The DFIs is not why Lab was created. Lab is doing this to get extra profits, right? So this is why Lab exists. Lab goes to Mexican banks, retail banks, and says, okay, will you help us fund to low-income borrowers in in Mexico to fulfill our mandate? And the Mexican banks say yes, but they'll only do it if there was some way they can pay their losses. So Lab says, okay, if someone borrows the money but doesn't pay you back for any reason, provided it's not the bank's fault, Lab will refund 80% of the face value of the principal. So in effect, the retail banks are only going to lose 20% on this venture. When we started the study, credit guarantees was out of scope, equity grants was out of scope, mentoring, microfunds, and others out of scope. It's just the DFIs that Lab wanted us to look at. So now the question is, why did Lab, a Mexican bank, decide that it was going to pursue the DFI market, the distribution financial intermediary market in the US, so aggressively? Well, it actually is linked to credit guarantees and a very, what's the word I'm looking for? A very, very aggressive new Mexican president who came into power a few years ago with a staunch belief that Mexico could be made productive and wealthy by dismantling protections that existed around key sectors and incentivizing them to become more competitive. So he's done that in the oil and gas sector. And on the 9th of January 2014, which is only about 11 months ago, he signed into law a similar act of government that began a process to dismantle, firstly, the stringent regulations that protected the banking sector, and at the same time, he wanted to ensure that the poor, the disenfranchised in Mexico, received access to funding. So how does this impact the US market? What's happening with Mexico? Well, it has a pretty big impact. And the logic is as follows. State-owned banks, or any state-owned organization, exists because the private sector will not do the work itself. That's how financial and economic theory works. If the private sector can do something, the state shouldn't intervene. So if a state bank exists, that means that the bank is doing something that the private sector doesn't want to do because it's not profitable. Because if it was profitable, if there were attractive returns, the private sector would have jumped in, which implies that if the private sector has not jumped in, either the regulation or the returns are too onerous, or their returns are not there. So what that means is that Lab, as a state-owned bank, exists to provide a service that is unprofitable for private banks to exist. So funding low-income entrepreneurs in Mexico and Latin America who are of an ethnic background is not very profitable. So that's why Lab exists. Now, that's what it means when it says Lab will incur losses in Mexico, since it is partially the role of a state-owned bank. It is the role of a state-owned bank to incur these losses until the sector grows to a point whereby it's attractive, and then the private sector can step in. The state-owned bank withdraws, and the government then, basically withdraws from that sector, takes all the capital it has deployed to help in that sector and deploys it to another sector where the private sector will not get involved. Now, why does this matter for Lab? Why was Lab worried so much about entering the US market? Right? It's very simple. If you look at this article that was put out by the Wall Street Journal describing the new legislation, this part here really stands out. So not only was Lab in an unprofitable market, the president was saying that Lab had to increase its exposure to the unprofitable market by 15%. So Lab had to become bigger at losing money, basically lose more money. But at the same time, part of the changes the government was rolling out meant that it would no longer subsidize Lab's losses. So Lab had to increase the amount of losses it was taking because it was increasing its exposure to an unprofitable market. It needed to figure out a way to subsidize those losses with profits, and the cross-subsidization would no longer come from the government. And that is why Lab wanted to enter the US market, because in the US market, Lab believed that it was a more profitable and successful market. More money could be made there. So let's look at both channels, right? We talk about credit guarantees, where Lab works through retail banks in Mexico. Those retail banks provide loans to locals in Mexico, and if the locals don't pay back the retail bank, Lab is on the hook. So what happens here? Well, basically, you've got all these retail branch networks along the Mexican-US border on the Mexican side, and obviously listing some of the major ones, they were branch networks even in the south, which was even poorer, right? But this is what was happening. People would borrow this money, but they were not keen to spend the money in Mexico for a variety of reasons: lack of opportunity, perceived corruption, and so on. So what they would do is they would send that money to either relatives in the US, or they themselves would cross the border and go to the US. Now this may seem like a small amount, but it was a pretty substantial amount. 80% of the money that retail banks in Mexico were funding through the Lab program was ending up across the border. Now, Mexican banks don't have any recourse, no legal standing to recover that money in the United States. And frankly, the banks have little incentive because the money is basically insured through Lab anyway. So this was a struggling business, but Lab, when we started, had a lot of praise for this business. They believed it was a sound business, and they made it very clear that credit guarantees were not part of our study. We were to leave them alone. They felt that the DFI business, these 18 distribution financial intermediaries spread across the border states of the United States, was the future. And what Lab believed was that the US market was more stable, larger and more profitable, and that given the fact that so many of the demand of the market was coming from these entrepreneurial immigrants who were on the US side of the border, Lab should target them, right? But beyond just the attractiveness of the market, Lab, quite frankly, believed that the DFIs were a bottleneck. They were inefficient, which is why their loan sizes were so small. They were poorly managed, which is why their cost structure was so high. And they were inefficient, which is affecting both the revenue and the cost base. But beyond that, the internal strategy unit within Lab, which is actually run by a couple of principals from BCG, Bain, and McKinsey, and made a strong case to build a US retail branch network. And when we came in, and at least when we were approached, Lab had already begun planning the market entry. In a sense, Lab had decided that the US market was attractive, that was not open for debate, and was merely seeking an operations plan to enter the market. And this is the key thing. When Lab issued its RFP, it was not an RFP asking anyone to analyze the market. It was an RFP for how Lab should go about setting up the retail branch network. Now, when we release the material shortly, you can see the actual RFP. Actual wording that Lab used. You can see they wanted a pilot study. They wanted an operations study of setting this up and how to run it effectively. And the RFP was issued on the basis, as I said earlier, that it must be assumed the retail lending DFI market was attractive to Lab, and that assumption should not be challenged. And they never said don't challenge the assumption, but by taking it out of the scope, it implied the assumption shouldn't be challenged. And in fact, in the initial discussions, they made it clear that they'd done the internal analysis. So the RFP was always about identifying the structure and efficient retail branch, looking for a pilot design which, if it worked, would then be scaled up, and all products and channels except for the DFIs were out of scope. Now this RFP was sent to McKinsey, BCG, Deloitte, PwC's, I think, audit arm, and Bain, and they were all invited to submit proposals. And the proposals were in two phases. One was an initial phase, which was basically the firm's thoughts, and then final proposal rounds. Now, if you listen to the premium podcast, you can listen to the initial telephone call we received from Philippa, who is a McKinsey consultant we placed into a Latin American office, who eventually ended up working for Lab. And she contacted us because she believed that while this RFP was going out, there was a lot of apprehension within Lab because one of the executives she worked with, Guillermo, who was a senior vice president appointed by the Lab CFO to overrun the study, wasn't comfortable with the direction of the study. And she felt that he needed someone to speak to who wasn't vested, because the internal strategy unit was obviously going to not criticize their own work because they had supported entering the US market, and she wanted him to speak to someone independent. So you can listen to that initial phone call we had, the follow-up discussions and so on. It's all in the premium podcast in terms of how we structured the study, what she told us, the discussions with Guillermo and so on. But what we did is that once each of the firms sent through the initial thoughts, we sent through a very different document. Our document was basically built around this slide. And while a lot of the firms were focused on this part, we came along and said, okay, there's three things you need to answer. Firstly is, why is Lab doing this? We can gather it's because you want to improve your performance against the Lab mandate, which then becomes the question, how will entry help Lab perform against its mandate? Well, it'll only help if we, being Lab and Firmsconsulting, can do a better job in the DFIs of handling the retail market, or if we can buy out the DFIs and bring them onto our balance sheet while improving the DFI's performance. Now, if we cannot do that, there's no point in proceeding. But even if we could do that, there's another point we wanted to reach. Feasibility is a relative term. It's not whether the retail channel is effective. We said that's a moot point. If you just ask people to determine if the retail structure is profitable, that is worthless. And we'll tell you why it's worthless. Because if you are losing money on the on the loans issued in Mexico to the sum of $230 million a year, that is essentially the profits the retail network in the United States will have to make to offset those losses. And if you cannot offset those losses, and you are not confident of projecting you will be able to offset those losses in time, what is the point of entering the retail structure in the United States? So it's not a question of whether it was feasible, it's a question of whether it's feasible enough. And finally, we said once you've done all of that, so once this makes sense, once that makes sense, you then have to come here. Now, the way we designed this is quite interesting. As a partner, one of the rules we operate on is that a client rarely knows what their problem is. We will never go into a client who says, this is our problem, it's only this, you just focus on this, because we know clients misdiagnose their problems. So part of building in that branch, and that branch was giving us a chance to take this overarching view of what was happening so that we could confirm that the DFI was really the opportunity to Lab's problem. And you will notice that by doing this, we uncovered a lot of other problems which became the focus of the study. And of course, one of the most important things we did is that by reframing the question and answering not the question that Lab wanted to answer, which was this, but the question that we felt was worth answering, and building the case for them to answer that question, we ended up saving the clients a minimum of $150 million. If you go on the average case, it's probably around $250 million. And best case, probably $350 million. Now, convincing the client to change their mind is difficult. And we had a lot of discussions with Guillermo, helping you understand why you had to do these things. Why do you have to answer these questions? Because essentially, we're telling him the internal strategy unit was wrong. But how do you tell a client your internal strategy unit was wrong? Well, you do it by explaining to him the vested interests at play. And it's something we explain in the videos. Internal strategy units don't do the work McKinsey and BCG does. That's a fact. No internal strategy unit at any company in the world has the influence that McKinsey and BCG has and the independence, because the internal strategy unit employees are there temporarily. Once they leave, they have to join a line division, because that's where power lies in a bank or in any corporation. So when you're in the internal strategy unit, you don't want to upset the line divisions. And because you don't want to upset the line divisions, there is a strong bias to massage facts and figures to give the line divisions what they want. Because if you upset them, you're not going to go far in this company. As soon as your 10 years over at the internal strategy unit, you will have to leave because no line division wants you, right? And no one becomes CEO by rising up to the internal strategy unit, because the internal strategy unit has no power, no influence, doesn't control the P&L, right? The head of internal strategy does not sit on the board of directors. He doesn't even sit on the management committee, or she doesn't sit on the management committee. At best, they will probably, my guess is, sit on an advisory council for one of the operating units, but not even for the entire operating council for the bank. So internal strategy units, by their very nature of the way they are structured, are biased, which is why companies like McKinsey and BCG, when I was a partner and so on, it was very easy for us to do this work. It's hard to replicate that independence. Now, one of the things you will see, if you've seen this in the tech strategy study as well, we talk about the importance of doing a top-down analysis. And this study, when we came in, people said, don't look outside of the DFI market. But we said, okay, one of the key steps is we want to identify the strategic position and intent, which is also known as a top-down financial analysis of the client. Now, this step took us 36 hours. It took us literally 36 hours. It was myself and Albert doing this, 36 hours. Now, if you're in a corporate environment and you have to do this, you probably don't know what a top-down analysis is. If you go to the header and footer menu for Firmsconsulting under executive programs, under strategy executive programs, you'll see something called analysis library or strategy library. Click on that. In there, we have a lot of videos on how to do top-down analysis. Top-down analysis must always be done because a top-down analysis is a quick and dirty analysis telling you whether or not the detailed analysis is worth doing. In every single study I've done as a partner, I ensure my teams do a top-down analysis. Now, when I was a partner, I had some really famous strategy partners and so on who, if I mention their names, you'll know them, but I don't want to do it because I don't want to give away any details or make them look bad through what I'm going to say. There were some partners who liked skipping the top-down analysis and going straight into detail. You should never do that because true analysis is checking things. And the top-down analysis step is a check. Even though you are absolutely sure something may be the issue, the top-down analysis, which literally lasts 36 hours, is the check to make sure you're doing the right analysis, right? We started there, and because of the top-down analysis, we figured out that the problem the client was chasing was not actually the problem that they needed to work with. We then looked at the target markets. Remember, the United States has 50 states. Banking is regulated at the federal and state level, so you've got 2 sets of legislations for 50 states. That's a lot of analysis. You have to sort of pare this down. You have to understand a competitor's business model to understand how they're making money, if they are making money. Are they making money in a way that's scalable? You know, understanding competitors' business models is not about reading their annual reports. Trust me. You will see that when we did the case studies and benchmarking work, we went out and we spoke to former CEOs, former financial managers, because we wanted to corroborate those glittery, wonderful statements in the annual reports of what was really happening. Finally, we have a very interesting way of doing case studies. A lot of people fall for this trap of analyzing a good company and a bad company. And what they say is a good company like Google only has good best practices. So for example, if you're analyzing Google, go analyze the HR department because Google is so successful, therefore the HR department must be successful. That's nonsense. For all you know, Google's HR department is terrible and Google is successful despite the disaster that is the HR department. Think about that for a second. The inverse of this trap is you look at a company performing badly financially and you say that because a company is performing badly financially, everything about that company is a disaster. Both of this is called the halo effect. By looking at the profitability of one attribute of a company and assuming that one attribute determines how every other attribute performs. So when I do case studies with Peter, was leading the case study, I made it very clear to him, I don't want some kind of nonsense where you tell me Grameen Bank is the world leader and therefore let's analyze everything about Grameen Bank because it's all perfect. No. Within Grameen Bank, there are disasters. If you want to analyze a disastrous attribute of Grameen Bank, do it. But if I see a case study where you tell me that, for example, Grameen Bank is regarded as the best at doing this, so everything must be perfect about them, I know you don't know how to do case studies. So when I look for case studies, I don't want you to case study a company, I want you to case study one attribute. Figure out the most important attributes that are relevant to lab when they enter the US market and case study just the attribute. And if you come to me and tell me that Bank X is regarded as being unprofitable and unsuccessful, therefore there's nothing you can learn from them, that's a problem for me. Once we did all of that, we sort of list the entry options, understand the critical success factors, and then constantly analyze those entry options. And of course, we planned this assuming that it made sense and we developed the pilot, but obviously at this stage we reached some kind of a break point. Now, this way of listing things can also be rewritten in a different way. And basically, what we realized here is that after doing the top-down analysis, we had to go through a process of proving to the client why retail banking didn't work. Now, when you shatter a client's sacred beliefs, you better be damn sure you are logical. And then we had to focus our analysis on insurance. So the study begins with the economics of retail banking, but very quickly shifts to basically the act of insuring deposits, right? Or loans in this case. And there's two ways of breaking this down. One is to say which states, which vehicles, which is the best route, or in a more detailed way, which products and services, what value chain activities you need to focus on, because the rule of thumb is the more value chain slivers, the more fragmented a value chain is. Since each player tries to make a margin, the more fragmented a value chain is, the more costly something is. So the rule of thumb is that when a bank or anyone wants to enter a new market, are you consolidating the value chain or fragmenting it? Because if you're fragmenting it, all other things being equal, you probably are going to struggle to make money unless you found some way to be the dominant link in that value chain. What type of business model is appropriate? And being a retailer is not a business model. How you make money by being a retailer is your business model. So you have to figure that out. For a wholesale bank, which basically has a bunch of experts sitting in Mexico City, how are they going to build a retail structure of generally lower, I wouldn't say educated, but people who have lower education, probably undergraduate degrees if they're lucky. You don't have PhDs working in the retail branches processing loans. How would you build that out? Would you build out the critical path? Will you build out everything at once? Will you build it out based on what you could afford? And then how would you implement this business model into your organizational structure? And those are the key things we had to answer. And finally, one of the things that really, I think, impressed this client a lot is we told them and we explained to them. It was like really, putting up, I remember sitting in this room with Guillermo. He's got a whiteboard and he's trying to explain the logic. Is that what I told him is that lab entering the US market should be an option, but is your option of last resort. And that's something they never understood. What I explained to them, and I basically used the thinking of a professor called Shi-Fen Chen. He's from the Richard Ivey School of Business at the University of Western Ontario. He published a set of papers from 2008 to 2012. Where he was able to explain, he was able to take anecdotal evidence and create the structure to explain why, when a company enters a market, when a company goes from Mexico to the United States, when no CEO in their right frame of mind wants to enter a new market, it's risky, it's difficult, there's a lot of capital at risk. A CEO would much rather actually want to extract the profits from that market without entering it. That's what a company wants. They want the profits from a market without taking on all the risks of entering a market. If that's true, which it is, entering a market is your option of last resort. There are other options that allow you to extract the profits from that market before entering the market. Licensing, JVs, outsourcing. Those are all techniques to extract profits from a market. And if you want to know more about this, you'll see it in the study, but there's also a podcast on this called The Correct Way to Do Mergers and Acquisition Studies. It explains this in a whole lot of detail. So when we explained this to Lab, it also helped us a lot. Because Lab was under the assumption that if we don't enter the US market by setting up a retail structure, we cannot get the profits from the US market. And what we told them is you can get the profits from the US market through other mechanisms. Our job is, if we assume the retail structure is the right structure for you to pursue, if we can prove that, then we have to figure out how to get the profits from that structure. But before we look at just entering the market, what are the other mechanisms available to you? And only if those mechanisms fail on a risk-adjusted return basis, then only do you consider entering the US market. And the fact here is that entering a market implies that everything else failed. It is your last resort. It is the most risky option for a company. And this may be counterintuitive, but it is true. And it is a very, very clever analysis that this Taiwanese professor did, who studied at the University of, I think, Illinois. And it is profound because it changes the way strategists look at market entry. And of course, we knew this before he wrote his paper, but I don't think anyone's explained it in such an elegant way. And it helped us because we had a way to tell the client, don't worry, you should not worry so much if we're putting a hold on all your pilot work to enter the US market, because it doesn't mean you can't get the profits from the US market. It just means there may be a different channel for you to do this. Now, of course, if you're telling a client they're wrong, you've got to be damn sure there's profound logic sitting behind your thinking that's going to help you talk the client through this. So one of the early things we put together when I was still structuring the study before the team arrived is this option set of what are the options available to Lab. So, for example, should Lab enter the DFI market correctly? No. Yes. Now look at this, right? A good strategist spends the bulk of his time trying to prove something wrong. If a client wants to do something, I always take the opposing stance. The reason I take the opposing stance is not because I want to be difficult.
It's 1 o'clock.
It's because I want to make doubly sure that we're doing the right thing. If the client says we want to enter the market and we arrive there and say, hey, you know what, we can't lose this client, we've got to help them enter the market, our mindset shifts to this direction and we're not helping the client. We're doing what the client wants to do without determining if what the client wants to do is in their best interest. So by taking this opposing stance, the analysis eventually is going to either prove my initial hypotheses wrong or prove them right. If I'm proven wrong, that's fine. At least I took the opposing viewpoint and I know that I'm doing this because it's the right thing to do. If I'm proven right, then at least I know, look, I spent the bulk of the analysis ensuring that I'm going to tell a very important client to basically stop what they're doing, and I know I have the supporting argument here. This is self-explanatory. You can go through it yourself, but the point I want to make here is that whenever you're doing anything in strategy, it's always about a set of options. This is something you have to understand. A client trying to get from point A to point B always has multiple routes. Now, you can sit there and try to determine if there's a situation where a client only has one route, and that's impossible. A client only has, I would say, a minimum of maybe 3 routes. But every client, irrespective of their situation, has multiple routes to get to the same outcome. Our job as consultants is to analyze the routes and tell them which is the best route given the trade-offs they have to make, right? And that's the overview of the strategy. And we did some pretty interesting things here, right? For example, Lab is governed by a set of X of government, 5 of them actually. And one of the things we've learned many times is that people, no matter how senior they are, even if they're called an expert, don't read the source material. So we looked at Lab's mandate. Lab's mandate says they have to do X. We went back and we skimmed through all 1,000 pages. It was about 1,200 pages across the 5 X of government, which basically created Lab. Do you know what we found? The performance metric Lab was maximizing is not the metric that they were founded to maximize. As bizarre as that sounds, I've seen that a few times for companies. Because over time, what happens is that when something is very complex, people rely on experts, and you hope the experts have done their work. But oftentimes the experts are under pressure. They don't check things carefully, or they don't keep up to speed. So we went back and checked things. So it's a big finding for us. The other trade-off we made very clear to Lab is that you want to provide loans to low-income entrepreneurs in Mexico and the United States, right? Good. But are you going to fund sectors that are, producing a lot of revenue and profits but very little employment? Or a lot of employment but very little profit? There's a trade-off here. You can't have both. In an ideal world, you'll find a situation, but in the real world, not everything's normally distributed. So at some point, you have to make that trade-off. A lot of profits, little employment, or do you want to create a lot of employment with little profits? Now, the decision framework we built for them doesn't exist anywhere. It's one slide, actually, and it is probably one of the most elegant things we created. This was, I would say, the most forwarded slide we did in the study. It went everywhere. It went to the government. It was presented to the minister. The minister presented it. It was used everywhere in every internal planning session. It became a fundamentally crucial slide. And you can see what we did was something that didn't exist before. We took data and presented it in a way that made sense to people. And this tool became phenomenally important. The other toolkit we developed for the client is a simple thing. How do you know a business is poorly run or its business model is fundamentally flawed? For example, when you see a business performing poorly, how do you know the business model is flawed or the CEO and management team cannot run a great business model? Now, in hindsight, it's easy to say that. Think about how many companies you analyze in the media today. It's very easy for people to say, wow, Facebook is a success, until it's not a success. MySpace was a success until it wasn't a success. Sony was a success until it wasn't a success. The problem with a lot of analysis is it's easy in hindsight to say what went wrong. It is much tougher to predict, right? And there's a term for this. Prescriptive analysis is where you prescribe a route of action. That's what management consultants do. We don't come in and say this company did it, therefore you should do it. No, we say this company did it, this is why it occurred as it did, and we prescribe the following steps for you. The worst kind of analysis is where you can only be right after the fact. So it's a small point, but it's a crucial point. It's very difficult to know when something is just poorly run or its business model is fundamentally flawed. There are a lot of businesses today which seem successful, but their business models are fundamentally flawed. They're doing well because competition hasn't caught up with them. And there are other businesses who are doing poorly, but they are fundamentally poorly run while their business models are sound. And it comes down to investment theory, right? It's like what Warren Buffett says. Is this a business with a great business model, or is it a great business model that is poorly run? And if it's a great business model, if we buy into it, could we replace management and get it running? And that's pretty much what private equity firms are asking. This is the fundamental question. Is something poorly run, or does it just have a bad business model? And we create a set of tools to determine that. Now, we do a lot of complex analysis here. One of the more complex studies we've done, it's, teach you everything you need to know in a McKinsey and BCG study for strategy. And to some extent, operations as well. Presenting such complex numbers can become very difficult to create an understanding with the client. So we had to create some very elegant way to present the numbers. I mentioned one of the slides we created to do that, but we created other slides to do that, right? And the complexity of this study cannot be underestimated, right? Lab's interests changed in different markets. And here's some of the things we had to think about. In Mexico, Lab must focus on the poorest markets. It does actually incur a loss and is mandated to lose money to help the poor, right? We know that. That's its mandate. Now, what should Lab do if it wanted to fund poor Mexican immigrants living in the United States? So let's assume on the 1st of June, one was in Mexico. On the 2nd of February, he was in the United States. He's the same guy, but if Lab was funding him on a loss basis in Mexico, should it still fund him on a loss basis in the United States? A big debate, right? The DFIs and the credit guarantees are fundamentally different economics. One is basically an insurance scheme, and the other one is a retail distribution network. Understanding them is quite painful, I would say, and we use some very creative analysis, which actually turned out to be 100% correct, because there's now a few months since the study was done. We've been in touch with Lab. They've checked some of the numbers and they seem quite happy with it, right? Building the analysis for both was actually quite difficult. We did the study over roughly 7 weeks, and to do that in 7 weeks to that amount of detail and accuracy, following the 80-20 principles, ignoring the unnecessary analysis, and to still be right after our study was then audited by Grant Thornton later, that's quite impressive. The US is a fragmented country. Insurance, consumer credit interest laws, state and federal laws govern them. So you eventually got 1, 2, 3 times 3 variables by 2 levels of analysis, state and federal by 50 states. You've got 6 times 50. You've got a minimum of 300 permutations. We also have a client who was really convinced the US market was the right way for them to go. When we submitted our initial thinking on the proposal, we were alone in pursuing the hypothesis this was a bad idea. At least that's what Guillermo, the senior vice president, told us. And why would he lie, right? Trying to convince a client to abandon an idea they've already started implementing, which is supported by their people, is always difficult. And you will see how a lot of people confuse being detailed with information overload. We are very detailed, but we are brutal on only analyzing the most important things. It is, most people when they do these analysis, they analyze everything because they have no structure, they have no decision tree, they have no hypotheses. We come into a major company, a massive bank, and we are very, very focused on the analysis, but we analyze the right things. And while there were some things, that was interesting about this study, there was also things that made it unique. This is a real client. In the podcast, you can listen to the audio recordings of the client talking about different things, and various podcasts will roll out in the next few weeks. You'll listen to even more audio recordings of the client. This makes the study unique. This was done recently, so everything that you can see is now being rolled out. We live blog the entire study. 600 A4 pages. That's how much of writing I did every single day, in the morning, in the middle of the project, at the end of the night, typing up my thoughts. We've taken all 600 pages, we've re-edited them, reclassified them, and we've linked them to each part of the study. So when we release the study, you can follow each of the text descriptions related to each part of the study. We have documented the entire process by recording all of the interviews. We're going to edit those interviews and put them into podcasts for you. Obviously, depending on popularity, if clients find this is not a very useful series, we may cancel them, but so far looks good. In terms of complexity, this is in order of magnitude. You've watched the tech merger strategy. On order of complexity, this is 1 to 50. This study is 50 times more complex than the tech merger strategy. So why did we do that? Well, there's 2 things you're learning when you watch our studies. One is how to do the analysis, and the other one is you are learning the core skills. Now, if we rolled out a study with a lot of analysis and teaching you the core skills, you'd get lost. So in the tech study, we just rolled out not too heavy analysis, focusing on the core skills. Here, we went heavy on both. Analysis is complex, and the core skills, well, it's basically exactly what we did in the tech merger strategy, just applying it to a much tougher problem, right? A lot of the analysis we had to do and so on is not textbook. These are not things you would find in a textbook. They are designed bespoke for the client. You will not find them elsewhere. And if you pull up one of the Mexican government reports, they probably use a lot of our work, and you see it. It's not something that you're going to find anywhere else on the internet or is taken off from some framework somewhere, designed just for the client. The financial modeling is complex. It's going to be hard, but we've broken it down in a much more user-friendly way so you can follow our thinking more carefully. We are essentially tackling 2 topics here. One is the strategy and economics of market entry, and the other one is the strategy and economics of retail banking / insurance or guarantees. 2 different topics. Analyzing them is different. We have to reconcile them and make sure we're doing them both in a way that makes sense. And of course, the volume that we are analyzing is significant. 120 interviews that we were allowed to record. Probably did another 100 interviews that we were allowed to record, some of them, but not all of them. 9 states were being analyzed, all of the border states. Of course, all of this is done at the level whereby we break down the analysis and planning to a day. So basically, when we're structuring the study, we ask ourselves, on day 1, And day 2, what does the day look like? What are we doing in the morning? What are we doing in the afternoon? And that's how we plan our studies. So you can have this level of rigor, this level of detail that we're applying to the situation. It's not if we're going in there and saying, okay, we're going to do the market analysis over roughly 3 days. No, that's what you do in a fictitious study. This is a real study. We time things to the hour. If Guillermo wants a report at 2 p.m. on a Tuesday night, I know I've got to give him a report by 2 p.m. on a Tuesday night. So I am mapping everything out to the hour. This is a format that we like using and we think it makes a lot of sense. Finally, I'll come back to what we said earlier. Our studies are designed in such a way that anyone watching our studies and going through the material carefully and learning from them will be able to walk into any strategy, operations, and implementation study anywhere in the world and do the work. And we know this works because the interns we put onto this study used the technology study to train themselves for the lab study, and they did phenomenally well. So well, in fact, that the client hired them at the end of the study. So the objectives is a step-by-step guide for associates, analysts, and managers. And we say managers, we're not just referring to managers at consulting firms, we're referring to executives, junior level executives, senior level executives at corporates. We provide the toolkits, templates, and the answers. You can see how it's done in a real study. You can listen to what the client is saying. And of course, we make it fun. You cannot love something and enjoy it if it is boring, which is the way business is taught in business programs around the world. I mean, I've sat in some of those MBA classes. They are terrible. You cannot learn strategy consulting the way MBA programs teach you. If MBA programs could teach you strategy, then when I was a partner and McKinsey and BCG are now doing it, they would hire you without doing case interviews. But they have to do it. And if you've ever worked on a real McKinsey study and a real BCG study and tried to apply exactly what you learned from your MBA program, you would realize it is dramatically different. Our studies is to provide that realism so that when you walk into a McKinsey BCG study, or if you're an executive who wants to operate at that level, it's a seamless transition. Of course, I hope you enjoyed this overview, and I hope you're ready to get started for one of the most complex and most enlightening and probably the most realistic studies we've done so far. And of course, if you have any questions, you're welcome to post them below, and I'll be more than happy to respond to them and provide any supplementary material and understanding.